Welcome to the deep dive. Today we're digging into something called superstocks.
Yeah, these are companies that might look pretty ordinary on the surface.
Right, but they have this hidden potential for, really big price jumps, often because of something specific, like a takeover.
Exactly. And our main source here is Charles LaLoggia's book, The Superstock Investor.
Yeah.
He had this knack for finding these companies.
So our mission today is to unpack his methods. How did he spot these opportunities when maybe the rest of Wall Street wasn't looking?
It wasn't about finding the next Apple or, some brand new tech.
No.
No, his focus was different. He looked for an event, a catalyst, he called it.
A catalyst.
Yeah, something that would basically force the market to wake up and see the company's real value, and boom, the price jumps.
So for you listening, this is really about maybe getting a new perspective, a different way to look at the market.
Definitely. It's about those aha moments, finding value where others aren't looking.
A framework maybe to find these overlooked companies yourself?
That's the idea. So where do we start? LaLoggia first pointed out why the usual ways of analyzing stocks often miss these super stocks.
Okay, so he tackles that big idea in finance, the efficient market theory.
Right. The theory that says all information is already baked into the stock price, so you can't really beat the market.
But he didn't buy that entirely.
Not completely. He argued it might hold true for, the huge, heavily followed companies.
Like if IBM misses earnings, the stock reacts instantly.
Exactly. But for smaller companies, ones that maybe only a few analysts cover,
Mm-hmm.
he said the information just doesn't get processed as efficiently. An earnings miss might barely cause a ripple, at first anyway.
So there are pockets of inefficiency. That's the key.
That was his argument. And then he gets into relying on the experts, the analysts.
Right, and he was pretty critical there too, wasn't he?
Oh, yeah. He talked about spinners, people, even like really influential figures who might shape a narrative for their own reasons. And then there's the whole issue with analysts issuing sell ratings. It's harder than you might think.
How so?
Well, think about the Sunbeam case he mentions. An analyst downgraded the stock, faced a lot of heat for it.
And then the company collapsed, proving him right.
Exactly. But it shows the pressure. Analysts might worry about pushback from the company, from clients, even their own firm if they get too negative.
So objectivity can be compromised.
It can be. Look at Michael Mayo reportedly lost his job for bearish calls on banks, even though he turned out to be right about their low-quality earnings. Aggressive accounting, basically.
So being right but negative can actually hurt your career. That's something.
It really is.
Yeah.
And it's not just bias. Experts can just be plain wrong.
Oh, yeah, the book has some funny examples.
Doesn't it? Like the guy telling the Elvis to stick to truck driving.
Or the head of DEC saying nobody needs a home computer.
Or the patent commissioner thinking everything important was already invented.
It definitely puts expert opinion in perspective.
For sure. And then there's the media's focus. All that short-term noise.
Yeah, the constant reacting to every little market wiggle.
It distracts from the bigger picture, from identifying that long-term value LaLoggia was after. You got to separate the signal from the noise,
Absolutely. He also wasn't huge on just using earnings expectations or PE ratios as the be-all, end-all, was he?
No, not at all. He pointed out how much PE ratios fluctuate. Look at the S&P 500. Over time, the market pays very different prices for the same earnings, depending on the overall mood.
So a company's value isn't just its current earnings times some magic number.
Right. And you also have to factor in the big stuff, like interest rates.
How do they play in?
Well, if rates on safer things, like bonds, go up, money tends to flow out of stocks seeking those safer returns.
Okay, yeah. Puts downward pressure on stock prices overall.
Exactly. And sometimes that narrow focus on just one company's earnings misses that broader context.
So, okay, we see the limitations of the old ways. That leads us to his approach, the superstock paradigm. What's the big shift?
The big shift is moving away from just earnings forecasts. Instead, he said, focus more on, tangible asset values.
What the company actually owns.
Right. And crucially, look at industries or stocks that are, unpopular, out of favor.
The ones nobody's excited about right now.
Precisely. That's often where the hidden value lies.
And then you need that spark, that catalyst you mentioned.
The catalyst, yes. That's the event that forces everyone else to see the value you saw. And the number one catalyst.
A takeover.
A takeover bid. That's the classic superstock trigger. It forces a repricing, often very quickly.
Okay, this is where it gets really practical, because he said these takeovers aren't just random lightning strikes.
Not at all. He believed there are signs, clues, Telltale signs, he called them.
Telltale signs. Love it.
Yeah, things you can spot before the takeover happens if you know what to look for.
All right, let's break these down. What's the first big category of signs?
Merger and acquisition activity is a huge one.
M&A.
Okay, so what within M&A should we watch? Look for industries starting to consolidate. He used water utilities as an example. A few early deals hinted that a bigger wave was coming.
So one or two mergers might mean more are on the way.
Could be. Also, listen to what CEOs say in interviews. If they talk about growth through acquisitions, pay attention.
That phrase is a flag.
It can be.
Yeah.
And even failed deals are informative.
How so? A failed deal.
Yeah, say Company A tries to buy Company B, but it falls through. Well, Company A might still be hungry for a deal and look for another target in the same sector.
Okay. Or if two companies are fighting over the same target.
That too. The loser might go find someone else to buy.
Yeah.
It tells you there's appetite for deals in that industry.
Got it. What's the next sign? You mentioned beneficial owner accumulation.
Right. This is about tracking big outside investors. People or firms that own, say, 10% or more of a company.
Okay.
If they start buying more shares on the open market, that's significant.
Yeah.
LaLoggia liked the Vickers Weekly Insider Report for tracking this.
Why is that buying so important?
Well, these big owners often have deep pockets and do serious homework. If they're accumulating shares, they likely see undervaluation or anticipate something happening like a takeover.
Like the Rexel example in the book. They bought more, then a takeover happened later at a big profit.
Exactly. Even after their initial buying, there's still a huge opportunity.
And you mentioned Form 13D filings.
Yeah, those are required when someone hits 5% ownership. They have to state their intentions.
Investment purposes only or something else?
Well, sometimes it's just that. But other times, the language is vaguer. Or it might hint they want to influence management, push for changes, maybe even a sale.
So read the fine print?
Definitely. And watch for creeping takeovers. That's when someone builds a stake, slowly, under the radar, like Western Resources did with ADT.
Sneaky. Okay, what about stock buybacks? Companies buying their own shares?
Generally seen as positive, right? Shows confidence.
Yeah.
But LaLoggia saw it as potentially stronger, especially if insiders like the CEO or directors are also buying shares with their own money at the same time.
Ah, the double signal.
Exactly. He felt it could mean management thinks the stock is dirt cheap, and they might be worried about a lowball takeover offer. Like Midway Games, the chairman buying the company buying back stock.
Okay, that makes sense. What about poison pills? Shareholder rights plans?
Yeah, those are defensive moves to make hostile takeovers harder.
So kind of a negative thing?
You might think so, but LaLoggia flipped it. He said, why would a company bother putting one in place unless they felt they were undervalued and vulnerable to a takeover?
Huh. So the defense itself is a sign of perceived undervaluation.
That was his take. Then there are significant stakeholders.
Who falls into that category?
Think brokerage firms, private equity, buyout firms, big investment partnerships. If they hold a large stake, like 10% plus, especially in an industry that's already consolidating.
They have an incentive to make a deal happen.
A very strong incentive. There's sophisticated players looking to maximize their investment value, and pushing for or facilitating a sale is one way to do that.
Okay, next sign. Spin-offs and asset sales. Seems like just corporate housekeeping.
It can be more than that. If a company sells off unrelated businesses or spins off a division, especially if what's left, the core company or the newly spun off part, is in an industry seeing takeovers, well, it might be simplifying itself to become a more attractive target.
Like clearing the decks for a sale.
Kind of, yeah. Makes the company cleaner, easier for an acquirer to swallow. The water utilities did this, Weyerhaeuser too.
And insider buying, we touched on it with buybacks, but it's a sign on its own too.
Absolutely. When top execs and directors put their own cash into buying company stock, it's usually a strong vote of confidence. They believe things are looking up, or the stock's just too cheap.
Like Bright Lane, where insiders bought even as the stock was tanking.
Exactly. That disconnect is a powerful signal. Something's going on that the market isn't seeing yet.
Then there's the idea of pure plays.
Right. Companies that have gotten rid of side businesses and are focused on just one main thing.
Why are they more attractive targets?
Simplicity. An acquirer knows exactly what they're getting. No messy side businesses to deal with or sell off later. Think about the drugstore consolidation phase. Genevieve's, they became pure drugstores. Then JCPenney snapped them up.
Makes sense. Easier to integrate.
Much easier. You even look at chart patterns, surprisingly.
Technical analysis, really?
Yeah, specifically breakouts. If a stock's price pushes decisively above a level where it struggled in the past, a long-term resistance level,
What does that suggest?
it can indicate strong underlying buying pressure, maybe anticipating good news, like a takeover. Sally Healthcare was an example he used there.
Interesting. And finally, looking at industry leaders.
Yeah, sometimes a really strong performer in a sector can pull up the valuations of its peers.
How does that work for takeovers?
It highlights the value in the sector. If the leader's doing great, maybe an acquirer looks at a smaller, undervalued competitor and thinks, hey, we can buy that one cheaper and benefit from the same industry trends.
Like international game technology boosting WMS industries?
Exactly. And he also mentioned low-quality earnings. Again here, companies playing accounting games might become targets for someone wanting to come in, clean house, and improve real profitability.
Wow. Okay, that's a lot of signs to track. The case studies must really help illustrate these.
They do. The water utilities one we mentioned, perfect example of seeing consolidation early. He called Aquarian as a target, and boom, it got bought at 50% premium. The market just missed it.
And ADT. That showed multiple signs.
Oh, yeah. Western Resources, slowly buying shares, the creeping takeover. Then Republic Industries bids, fails. Then Tyco comes in and wins with a huge premium. It showed how these things unfold and that there were chances to buy along the way.
TJ International, that was about understanding industry relationships.
Right. Weyerhaeuser was already a big distributor for Truss Joist, part of TJ. Buying them made perfect strategic sense if you knew the business.
And Bryland showed that disconnect insiders buying, a big owner increasing their stake, but the stock price falling.
Exactly. Classic sign that the market's missing something the insiders know or strongly suspect.
Midway Games insiders buying plus the company buyback.
Yep. Plus some to Redstone accumulating. Signals of value despite near-term problems.
Copley Pharmaceuticals and Celanese that was restructuring paving the way.
Who just bought into Copley? Copley spun off Celanese, then Teva bought Celanese. The restructuring created the target.
WMS Industries Redstone buying, chart breakout, new tech catalyst.
Textbook Superstock story. Market was skeptical, but the signs were there.
And the drugstores, Faze and Genovese, becoming pure plays before JCPenney bought them.
Perfect illustration of that concept.
But then there are the warnings, right? The take the money and run cases.
Absolutely crucial. JCPenney went on that drugstore buying spree, but LaLoggia warned against holding JCPenney stock afterwards.
Why?
Because acquiring companies can stumble, integration is hard, they might overpay. The original thesis was about the target getting bought, not about the long-term success of the acquirer.
Like Mattel buying the learning company disaster?
Total disaster. Believing in synergy can be dangerous, his advice. Once your target company gets the bid, sell your shares, take the profit. Don't gamble on the merger working out perfectly for the buyer.
Same logic applies to Protection One getting bought by Western Resources or Waste Management merging with Allied Waste.
Exactly. Merger mania happens. Perceived benefits don't always materialize. Secure your gain from the target company being acquired. Take the money and run.
Okay, so if listeners want to try this, how do they start building a list of potential super stocks? Where do they look?
He suggests reading the financial papers, Wall Street Journal, IBD, NY Times. But look for the small items, little news bits about industries consolidating, or maybe a company selling a division.
Don't just read the headlines.
Right. Dig deeper. And definitely follow that Vickers Weekly Insider Report for the beneficial owner buying.
Okay.
Another good tactic is to actively look for companies that are already partially owned by another corporation or a big investment firm.
Because they have that built-in incentive we talked about.
Exactly. They want to see a return on that investment, and a takeover is often the best way. His book Appendix even had a list to get people started across different industries.
The key advantage being
you're potentially buying this takeover possibility without paying extra for it. The market might not recognize it yet, so it's not priced in.
What kind of mindset do you need for this? It sounds like it requires patience.
Oh, definitely patience and independent thinking. You got to trust your analysis when you see those telltale signs, even if nobody else is talking about it.
And be prepared for the market to ignore it for a while.
Absolutely. It can be frustrating. But LaLoggia argued that the longer the market ignores the value, the more time you have to buy shares at a good price.
So delayed gratification is part of the game.
It is. It's more work than just buying an index fund, for sure.
Yeah.
But the potential payoff, outperforming the market, is the reward for that effort and patience.
And that brings us back to take the money and run. Just to hammer it home, why is that so vital?
Because your reason for buying was the potential takeover of the target company. Once that happens, your thesis is played out.
The catalyst occurred.
Right. Holding the acquirer's stock introduces totally new risks. Integration risk, maybe the acquirer overpaid, maybe their core business hits trouble. Why take on those new risks? Secure the profit you made from correctly identifying the superstock target.
Makes sense. Lock in the win.
Lock in the win, move on to the next potential opportunity.
Okay, so wrapping this deep dive up, the core idea seems to be shift your focus. Look beyond earnings, look for assets, look for catalysts, look for those telltale signs.
Especially in corners of the market Wall Street isn't obsessed with.
And by doing that, you, the listener, can potentially spot these super stocks before everyone else piles in.
It's about developing your own edge, really. Thinking independently, interpreting the news differently. It's a new way to read the financial pages.
Which leads to our final thought for you today. How many companies out there right now, maybe ones that seem kind of dull or are struggling a bit, might actually be showing some of these early telltale signs?
What overlooked industry, what forgotten stock might be the next superstock waiting to be discovered now that you have this lens?
What opportunities might you uncover?